Willkommen zum Reinsurance Podcast, live aus Baden-Baden. Wir sind hier für die jährliche Rückversicherungskonferenz, wo sich führende Mitglieder der Branche versammeln, um über die neuesten Trends, Herausforderungen und Innovationen zu sprechen. Bleiben Sie dran für exklusive Einblicke direkt von der Konferenz. Welcome back to the Reinsurance Podcast. Very excited to have Eran Kaz from the Lockton Re Financial Risks team. And that's exciting because, as we were discussing, we don't think we've ever covered financial risks properly on the Reinsurance Podcast before. So you're our experts for the day. Welcome to the show.
That's great for you.
Thank you for having us.
No, excited to unpick it with you. I understand you've also both got experience on the primary side as well. So maybe you can help us understand how it works on the primary side. We can look at the reinsurance side, how that works. And then we can suddenly snap forward to the fact that we're here in Baden-Baden in 2024. And to think about that for too long, but yeah, it is 2024. So who wants to start maybe with a bit of primary?
You normally start, Hash.
Do what? So which bit do you want to know about? Because the credit risk market's massive in terms of what they actually cover.
What's in there? What are the sort of headline categories?
So you've got your short-tail trade credit, which is all your portfolio business. You've got your sort of medium, long-term structured trade credit, and then you jump more into Eran's bag, which is surety, which I've never fully covered, but you always you love talking about surety.
So surety's the other, if you will, element of the class, and then the last one we normally talk about is mortgage.
Yeah.
And then in recent years, we've seen more and more banks coming into the space with portfolio solutions. It's called SRT in Europe and CRT in the US.
Appropriately insurance confusing. So yeah, brilliant.
Nothing like a bit of three-letter acronyms to really confuse everyone.
Yeah,
nice.
But basically, the real thing to just think about is if there is a credit that is offered. So if you've sold something and there's a credit involved, you can insure it as long as it's not rubbish.
Yeah, to make sure people actually pay and
yeah, exactly. Yeah.
That makes sense. Cool. And so I remember there being lots of strange things when I first learned about it years ago, you know, doing my exams about 25-year-long policies and all sorts of things. How does it work in the reinsurance space? Because there's lots of interesting things in the primary space.
So generally speaking, the reinsurance treaties are done on a risk attaching basis.
Yeah.
So the treaties tend to be 12 months, and then anything that the primary cedents are writing in that time period is captured. So the 25-year policy that you mentioned will be going into a treaty.
Makes sense. And are you on the same cycle as the rest of the market in terms of 1/1 is a big renewal season that's coming up soon? Or?
Huge amount of the business is done on 1/1, but we're busy pretty much every single part of the year. We've got one in nearly every month, which is fun.
Yeah,
I guess unlike more the property cat side, we are 1/1 heavy, but we're not only 1/1. So you do have 1/4, 1/5, 1/6, 1/7. So to be fair, we're quite busy throughout the year, and it's just historical reasons people buy for whenever they set up the book. I would say probably half the market buys are 1/1. So this is a big milestone for us to take a temperature and see what the market is thinking for the rest of the year. So this is where a lot of decisions are being made and pricing is sort of being discussed already.
But they don't have to move in a pack, because actually what's in a lot of people's treaties, it can be quite varied. So it's not like it's not like property. You can be quite independent with your buying habits, because if you're doing something weird and wonderful, then so what if you're with somebody else, like you're not with anybody else.
Makes sense. Very cool. And so what does Baden-Baden mean to you guys? Does a lot of the financial risks market come here to meet and do deals?
1,000 meetings in 24 hours. That's
wow.
As with everybody else. Yeah.
I mean, if you look at the reinsurance market in our class, so predominantly used to be written out of Zurich.
Yeah.
So you've got the Zurich contingency here. Mm-hmm. You also got quite a strong German contingency here.
Yeah.
So, the traditional players who've been writing this class for 20 plus years are all here. The newer players is what I consider the Bermuda market.
Yeah.
They're not here.
Interesting.
We don't really see them. But this is probably where the tone is set by the lead markets.
Interesting. And you mentioned at the moment there's a rather large amount of demand for these products. And so you're sort of on the hunt for reinsurance capacity in general as a market?
Yeah, absolutely. That's, I'd say, a large part of our job throughout the year is going to try and find brand new markets, educate them on what credit is, explain that financial risks is not financial lines, say that if you are worried about something correlating with your asset side of the business, don't worry. We've probably got something that won't correlate with your asset side of the business. So, we spend a huge amount of time speaking to people to try and get them into the market. We had one this morning, actually, that was quite fun, where, it was a slightly random meeting with our marine team. And we said, would you mind us tagging along? Spoke to a CEO, and they went, oh, this is fortuitous timing, actually. Can you come and speak to us in 1/1, and we'll set up a meeting and see if you can get us to convince us to write credit. And when we're normally pretty good at that, so we quite enjoy going and doing those meetings and boring people until they write credit.
I mean, what I would say is we're not stuck in the sense of who's riding the class, but it would be great to get more capacity in.
Yeah.
And what we're finding is there's the people who've been riding it for many, many years, and they understand it, and they know how to price it and how to assess it. And then you have a whole contingency of people who are not in the market yet, and it's getting them over the line.
Sure.
The big issue we have is we need to demystify it.
Yeah.
So, as you were saying, people have the preconception that it's all going to be 25 years, all emerging markets, it's all really, really badly performing. Why would I even go into it?
Yep.
And then we actually sit down and explain what the market is and the way it's developed since the global financial crisis. The first reaction is, oh, I didn't realize that.
Yeah.
So it's interesting trying to get people who are so focused on P&C and property cats to really open their shoulders and go, right, what else is out there?
Yeah.
Now, to be fair, we have seen people moving into the specialty space in the last 24 months as people are looking to move away from the property cat. So I'm sure that's a theme that we hear consistently across the specialty lines. We're really trying to push people to write our bit of the market in the specialty side, because if you look at the results, they're very, very strong.
Yeah.
The one thing that, again, people are not necessarily understanding is how does the primary product behave? What risk mitigations are available for the insurers? And what's the cycle? So, to answer your question, that's what we've been doing the last 2 or 3 years, just going to markets and educating them consistently.
It sounds like an attractive proposition. If there's a limited number of players, tends to be a bit more margin available. So.
Yeah, for sure.
Absolutely. And I think, again, because there's only a handful of leaders in the space, they've been able to command quite good rates.
Yeah.
Right? So they're getting really nice returns. And we had the last couple of years have been very interesting for the class, because whereas you would expect a COVID event to lead to lots and lots of losses on all things credit, we saw the perverse effect.
Interesting.
What happened is, on the back of government support schemes, there was money being pumped into financial systems. So effectively, there's been no insolvency, no losses. 20, 21, 22 are phenomenal years for this class. Yeah. Half the normal loss ratios. Just absolutely amazing stuff. We're now seeing what I would call return to normalcy.
Yeah.
So it's kind of, we're going back, but it's still not a soft market, right? Reinsurers are still able to drive terms, and they can be very selective in terms of who they support.
Yeah.
So we're constantly looking to push the market to do more. So we would love to get more reinsurers in, and that's what we're here.
Makes a lot of sense. And in terms of, I guess, the way of rating the business and the inputs and the data you need, it's not catastrophe models in your case. I guess you're following something else.
Credit rating.
Yep.
So, if you can either get a shadow S&P rating or ideally an S&P rating or something like that, then you can model it. And it's one of those, again, another thing to demystify with people who say, well, I don't understand how we can start on this. And you said, well, you just attach a default rating to everything and take it from there. And then decide what the rate works for you best and hope that works in your favour. So, it's not as hard to model as you'd think. It still takes some expertise, but we do. I think we have our actuaries sometimes go out and just sit in people's rooms for 12 hours and just walk them through it. It's really nice that way.
The way I look at this is, if banks can do it, insurers can do it.
Yeah.
That's
a great attitude, by the way. That's refreshing to hear, genuinely.
Look, the risks are no different to banks. The only difference is banks give you money up front, insurers give you money after the event has happened. Yeah. That's it. The underwriting, in terms of the modelling, is no difference. Yeah. The capital cost is, so we do a lot of work around capital modelling, and again, that's industry specific and that's location specific, but the mechanics of how to assess the risk are quite straightforward. Yeah. It's not that complicated. And the nice thing is because it's been a class been running for long enough, there's enough data points to actually give you an informed decision. Yeah. So people are very good at modeling and looking forward and understanding what the results are going to be like. Yeah. Which is, I don't want to say unusual for specialty, but most people think specialty is more an art rather than science. Yeah. We're at the science end of the specialty. Yeah. We can actually demonstrate results within profitable models and give you all the background to why it is like that.
Amazing. And so you brought me up to speed. I'm now going to ask you to bring me up to date with right here, right now, 2024. You talked about COVID a few years ago. Obviously, quite an interesting geopolitical environment that we're in.
To say the least.
Yeah, economically as well. Obviously, we've got elections looming in 2 weeks in the US. Interest rates and inflation, again, obviously quite a changing profile there. How do you make sense of all that? What are you looking at in this
It's really
space?
easy. No, there's nobody really needs to worry about any of that. I think the barrier to entry for the insurers is high. So the quality of the people that you're backing as a reinsurer tends to be incredibly high. So they are on top of the latest geopolitical issues, and they are absolutely making sure that their portfolios don't get overexposed to one particular area. Yeah. And that I certainly, when I joined the industry, you always shout me for this, but about 20 years ago, that was not necessarily the case. There was a lot less science behind it about what people did, and it was done a lot more on client relationships and sort of assuming that banks would do the right thing, which they often do. But they're a lot more careful now in terms of what they will write. So in terms of things like worrying about China, worrying about the US elections, you just make sure that your underlying portfolio is measured enough, and you'll have seen that quite a lot of the political risk portfolios will have stepped away from, say, China. They may not be totally overexposed to credit risk within the US at the moment, just making sure to see what happens post then. And it's never necessarily that whatever action happens is the bad action. It doesn't matter what the result of the election is going to be, but once they've got certainty as to what is the result of the election, they then make a choice as to what they're going to write going forward. But I think there's such a diversity of people in the market that they tend to get it right as a whole, which tends to work out quite well for reinsurers.
I think what's quite interesting about this class is there's a natural lag there, right? So what we're seeing now in terms of losses are policies that were written in 21, 22. So whereas the geoeconomical situation right now, the US election, the war in the Middle East, all that will not necessarily impact 2025 per se, but it will impact 26, 27 and beyond.
Gotcha.
So the insurers and the reinsurers are always forward-looking. So even more so than other classes, because you cannot step in and out of this class. So it's all about seeing what's coming ahead of the curve. So US selection class example, this is not a surprise. It's not a black swan event. This is going to happen, and people have been looking towards it, and there have been readjusting their portfolios accordingly. So, maybe going less aggressive in the US, or maybe making sure that US interests are protected across the world. There is a lot of underwriting rigor when it comes to geopolitics. Interest rates is another interesting one. So when we were here last year, a lot of discussion was interest rates are really, really high. There's going to be a refinancing cliff for companies who used to borrow money, at effectively 0% during COVID years, have to come back and get access to funds at 5-6% nowadays. What happened? That sort of went away again, because we're now facing into a reducing interest environment. So whereas people are sort of putting the brakes on last year already, we're just keeping easing into that. So it's a very dynamic class. People are very good at readjusting their risk profiles in their portfolios, and also the class allows us to do that.
That fly on your mic's really interested in what you just said. It's been there for ages. There you go.
Good shot. And to the point, I guess, on the dynamic market, when you come to an event like this, and when you're helping as brokers, your clients get the best terms and show that they are the cedents that the reinsurers should be backing. What's involved in that? Do you help them present anything in particular? You mentioned talent was key. What else matters?
Yeah, for sure. I think the individuals that you get in front of the reinsurers really, really matter. I mean, it's and making sure the bench is deep as well. So, it's not just the front person that is doing the deals. It's also what's their operations teams like, what are their actuaries like. Lloyd's, I think, have a regulation around needing specific qualifications for certain people that work on certain deals. So, it's quite important to make sure that you get the individual client in front of the reinsurers and just have them there ready to answer the questions, because like I say, they know their stuff, so it makes our job a lot easier. That actually, when you tee someone up and go and talk about the subject matter that you really love, and then they can crack on for ages. A bit like, you'll find there are a lot of geeks in the credit market, and because you do get interested in global affairs, and we'll do it for fun rather, and so then that comes out in the job.
Nice.
It's a very good question, because it's a case of, you would like to think at the end of the day everyone writes the same book. But when you really start scratching the surface, you realize that whereas this might have been true, say, a decade ago, we've seen across the market bifurcation of risks, the risk's appetite. So with size and scale also come specialization. So different people have very different risk appetites and different focuses, which our role then as a broker is to make sure these elements are highlighted when we present them to reinsurers. So what is specifically strong about your book? Why is your book very good in that industry but not in that industry? That's just our day-to-day job. And then behind the scene, we get the actuary to just crunch numbers and tell us, everything you're saying actually makes sense or it doesn't make sense. That's what we're focusing on. As Kaz said, it's all about talent. We have seen a shift in terms of the people who come into our industry. So as previously a lot of people who just did geography and geopolitics came to the market, there's a lot of bankers coming in on the insurance side. And again, because the product has shifted away from corporates buying it to banks buying it. And without getting too geeky, banks get a capital arbitrage using the insurance product. So we have a very interesting situation where people are actively buying the product and not necessarily buying it for risk reasons, but they're buying it for capital reasons.
Interesting. Yeah, okay. It is.
But the insurers must understand who is a good buyer and who is a bad buyer.
Yeah.
And you have to make sure that you have capabilities on your side as the insurer and also the reinsurer to understand what the banks are doing.
Yeah.
So it's always a case of, just staying one step ahead of the curve, making sure that you understand what you're doing. And again, our role is to make sure that the reinsurers understand that our clients are doing the right things and are proactive about it.
Global financial systems, complicated or what? So
the way I look at it, everything goes back to your pension fund. That's it. Don't worry about it.
Fingers crossed.
Yeah, as long as they perform.
2055, I'm leaving.
Yeah. Well, Eran and Kaz, it's been a pleasure having you on the show. Any final words for the people at Baden-Baden? I've kept you here a very long time because you've been wonderful to have as guests, but anything else you'd like to share before I let you go?
The market is ready for disruption, but in a positive way. We're constantly looking for more capacity to join us. We understand it's not an easy class to get your head around. And it's the one thing that when there's a headline in the FT, your CEO is going to pull you into the room. But if you have the right people and you understand it, which half our role as a broker is to help you understand it, it's a very, very profitable class. So please join us.
Yeah, go speak to some of the geeks. We'd like to speak.
There we have it. Brilliant. Thank you both. It's been a real pleasure, and have a great rest of the conference. We'll see you soon.
Thanks very much.
Thank you for having us.
Thanks.